Thanks for tuning into the All Funds Network podcast. My name is Mike Schroeder. Today I'm here with my co-host, Steinke and Evgeny Gokhberg. Evgeny is the founder and managing partner of Re7 Capital, a DeFi-centric investment company specializing in DeFi yield, liquidity, alpha strategies, as well as on-chain vault management. So we'll get into what all of that means today. Evgeny, thanks for taking the time, man.
My pleasure. Thanks for having me.
Great to have you. It's awesome.
Let's start with a quick background. So what's your, what did you do before this and kind of how'd you get into the crypto side of things?
Yeah, for sure. I spent over 10 years in traditional finance on the investment side, working in banks, in a hedge funds, dealing with all the, TradFi asset classes. And at some point I realized, there wasn't enough drama in that for me. So I started learning about blockchain, about crypto about 10 years ago. Got quite fortunate to kind of get involved in the Ethereum community early on. And the more time I spent learning about the space, the cooler it seemed. And eventually I left TradFi to join a blockchain startup who were doing like supply chain traceability, back in the day, like NFTs for physical objects kind of thing, before we looked at all NFTs. And eventually when I saw DeFi, it became pretty clear that this could easily be like a parallel financial universe that would exist. And if that's the case, then you can, combine the impossible, right? You can combine the best practices of the old school, TradFi risk management with a, crazy crypto ways of generating, uncorrelated sources of return. So I started building Re7 in the early days of DeFi to become kind of, the banker of the DeFi world, so to speak. So we started with a market neutral strategy, earning yield in DeFi by being liquidity providers, and it has evolved quite a bit. So fast forward to today, we're active liquidity providers, earning yield. We run a lot of on-chain vaults, and also are active investors in liquid and private markets directionally as well.
Very cool. Let's start with the vault side of things. So maybe to start off by telling us, just for the listeners here, what is a vault?
That's a good question. I think one of the broader problems of the crypto world is that we're throwing these nicknames across like a bunch of different things, and they don't, like you call something can be a vault and they do like different things. It's like USDC and the Terra stablecoin, they have nothing in common, but we call them stablecoins, right? So when it comes to DeFi, some of the risks you take are very similar, and some of them are very idiosyncratic and unique, right? So if you are staking your ETH, then you're providing security for one network. If you are restaking it, then you can choose where you delegate your capital, and then suddenly it's not just one network you're supporting, it's 100, a million, whatever. If you're lending, you can be lending against a bunch of different assets with different parameters. So historically, DeFi platforms were kind of vertically integrated. Someone is a talented DeFi founder, they raise capital, they build a platform, and then they manage risk. And what has become very clear is that people who are great at writing software aren't necessarily great at managing risk financially, because it's a different job, it's a different skill set, right? And some of the kind of next gen DeFi platforms, especially on the lending side and the restaking side, they started working with third-party partners where there are people, like Morpho, like Euler, who deploy lending platforms, and then someone else comes on top and says, "Hey, let me deploy a vault that will package up a bunch of different risks and allocate capital across those types of risks, programmatically, in line with specific like risk management functions and that sort of thing." So effectively, Re7 Labs, which is our arm that builds that software, we're effectively a layer on top of lending and primarily lending and restaking protocols, and we make it a little bit easier for people to just understand what the different risks they're taking on and how they should be managing those risks.
Yeah. Can I ask what types of risk, getting to that specifically, to your point, what types of risk are you talking about with your clients and kind of going forward here as you operate?
So when it comes to DeFi, generally you take 3 layers of risk, right? So you're holding an asset, you're putting that asset into a platform, and then that platform is on top of a specific chain, right? So you run the risk of the chain itself collapsing, obviously. And there are some chains, like if the Ethereum chain goes down, we should all pack up and get a normal job somewhere else. But with some smaller and more esoteric ones, that's a risk, and we've seen it in the past. Then the platform itself may be hacked. Obviously, that's the core risk of DeFi. And then maybe you're holding an asset, and that asset is going to disappear, like the Terra situation. Or you're lending against an asset, and then that asset disappears, and then again you're screwed. So therefore, what we try to do is we try to only work with the chains where we have some level of comfort that risks are acceptable, only with platforms that pass our kind of risk management due diligence process. And when it comes to picking the specific assets and the lending parameters around them, again, kind of modeling out what assets make sense, what are the underlying risks, what's the expected volatility, is there enough liquidity on chain to absorb liquidations, and. And maybe taking a step back, we've designed a risk management system for smart contract risk assessment and ReStaking, risk management. And we've even published a couple of papers on this a few years ago. And we've developed this way of thinking where we think of DeFi platform risk in the same way how a bank would think about giving you a mortgage. Mm-hmm. Right? Where from a bank standpoint, they give you a loan, maybe you'll default, maybe you will not default, but they know that if they give it to 1 million of you, then statistically, they can model out what's the expected default rate, and then maybe have some collateral, and then probably they'll be okay anyway. So we've done this kind of statistical and probabilistic risk analysis of DeFi platforms, and we've been able to bring that metric down with regards to our portfolio by like 20x. So we've been losing, much less, basically nothing, versus kind of the average for the DeFi space.
Who are the folks that are taking out these loans?
No idea. It's DeFi, right? So this is all fully, when it comes to these vaults, it's all fully permissionless, right? So there are DeFi primitives that have been built by people who build these lending platforms. Then we do like a filtering code, a filtering function where we say, well, it's okay to lend against this, but not against that. And then the rest is just DeFi.
So you guys are taking, I would say, generally collateralized loans. So somebody's putting some type of capital and they're getting maybe whatever stable coins or a different token.
Yes, this is all collateralized or over collateralized. Obviously, under collateralized loans, that's the holy grail of DeFi. There are a couple of projects who are working on this. We're speaking to them, and we'll probably be doing something with them once they're ready. But DeFi is not yet ready to do it at scale for obvious reasons.
Yeah, absolutely. How do you see kind of vaults evolving over time? Kind of as the future of asset management.
Well, they are the future of asset management in a sense that it's amazing to have a product where with one click you can get your capital out pretty much 24/7. So that's pretty amazing. And obviously they'll just become more and more sophisticated. Right, so there are some vaults already today where effectively they package up like pretty sophisticated trading strategies within them, and then they're available as a vault. Right, it's basically tokenized risk-return product because everything in finance comes down to a risk-return ratio that's packaged up in a product, and a vault is no different from tokenized, real estate or what have you. It's just something where you can click, and then there's a financial kind of flow in the back end. These vaults have only been around for a bit over a year. They've been pioneered by Morpho, and they've scaled like crazy. And currently, there are Web2 fintechs, as well as all the usual crypto kind of custodians and wallets who are embedding them. So yeah, they're evolving very, very quickly.
Mm-hmm. And you guys have deployed, just looking at my notes here, $600 million into these curated vaults. Yeah.
So we haven't deployed that capital, right? So we have created these vaults, and then other people have deployed their capital. But the size is right.
Cool. How kind of walk us through kind of when you guys started up until now? Kind of walk us through the process. $600 million is a lot of money. Obviously people trust you guys. People have you guys have done some research here. kind of how did that grow over time? Kind of where did it start, and kind of how has it expanded?
Well, the important bit is I'm glad you brought up trust, because people don't need to trust us in the sense that we're not taking custody of these assets, right? So if someone tries to force us to, take the money out, it's physically impossible because this is just all, smart contracts on the back of an underlying platform. So in theory, they only need to trust, okay, when I'm clicking into this vault, what are the assets, for example, I'm lending against? And all of that is visible and transparent. So then people can obviously do their own research. The reality is some people do, some people don't. But the great thing about DeFi is that everything is fully transparent and you know exactly what risk you're taking. Unlike, situations like FTX where you think you're not taking any risk, but you are. And in terms of how we got there, it started as an experiment a year and 3 months ago, where we felt that this could be. We've been invited to be an early kind of morpho curator, to run some of those vaults. So we started playing with it, experimenting with it, and it became very, very clear that that's going to be the future. So we've hired a bunch of people, built a lot of tooling on top of what we had previously, and yeah, it's just been a rocket ship.
Yeah, very, very
Yeah.
cool. Just kind of on that thought process, obviously DeFi's morphed and evolved in many different ways over time, across many different cycles, right? To that point, what you guys have learned, what have you seen over, the 3 different cycles that we've had, and how has it shaped your thesis on deal structuring or timing, or even just mindset in the space relative to DeFi?
Yeah, when it comes to DeFi yield, every day, every month, every quarter, every year is getting more and more battle tested, right? So I remember when was it? In 2020, when we had, all these issues in, what was it, March 2020, it was pretty scary. And then we were fortunate to be in the space, before Curve and Compound even had their token, right? So like pre DeFi summer. So, back in the day, it was let me put like a tiny amount of capital there as a test, and then let me see if I can actually ever get the money back. And when we started launching our original DeFi yield fund, it was pretty scary because, well, you have these weird incentives, you have these weird yields. Will it be alive tomorrow or not? You don't really know. How do you think about all these rugs, all these hacks? So it was very, very scary. But every day, every year, things are becoming more mature, more established. And fast forward to today, we feel the risks here obviously remain, but they're highly quantifiable and highly manageable. So, deploying an incremental dollar of capital within DeFi today feels a million times safer than it was 5 years ago, because the infrastructure, like even if you look at some very basic metric, like, percentage of money stolen in DeFi through hacks, right? Percentage of that metric is going down, right? It was back in 2020, 2021 was 20% probably. Now it's probably like 2 to 3%. So if you imagine in TradFi, when you have like a 20% default rate going to 2%, that's like a new reality. So
It's huge.
our thinking has become much more systematic as well, where we've brought in people who can analyze all these risks and run them very, very systematically, and then we have like this mathematical function that basically tells us, well, let's analyze this protocol across like 50 checkpoints, and then they get 40 out of 50, so then it's like a AA rating. If it's AA, we should put like up to X, and this is how we should manage that risk. And then on top of this, you put real-time risk detection and risk management tooling to kind of help you manage it further. It's just becoming more and more alike, TradFi kind of risk management processes. And eventually it'll get to a point where it's so safe and so comfortable that we'll need to move somewhere else to get the drama injection.
Yeah, there's a
Got to keep that drama around.
For sure.
Let's talk a little bit. So you guys have a proprietary DeFi risk index. Let's dive into that a little bit. Like, what is that? Kind of tell us, how you're calculating it. And I know you just kind of went into some of the details, but let's dive a little bit deeper there.
Yeah. So the philosophy behind it has been that there are two types of risk. There is known risk and unknown risk, and in theory, unknown risk exists everywhere. But if you're investing into real estate, for example, it's very hard to come up with an unknown risk. Yeah, maybe an alien is going to blow up your house, but that's quite low probability. And in DeFi, from day one, it's been very clear that the unknown component is quite material, and probably it's shrinking over time, but it's still there. So if that's the case, then you can never have confidence in your research. You always need to acknowledge that you'll be wrong once in a while. It's just inevitable. And the only way to protect against your own ignorance is to be very, very diversified. And if that's the approach you're taking, you can never say, is this green, is this red? You can say, well, this is definitely red, and this is not red, but it doesn't make it green. Which means you need to take a probabilistic approach, and this is exactly how agencies work in TradFi, where they say, well, this is AAA true will be triple C, and AAA doesn't make it risk-free. It just makes it an extremely low probability of something blowing up, but it can still happen. So that's pretty much how we approach it. And once we took this probabilistic approach, we realized that doing an audit is not enough, because even if an audit is done, it doesn't make something safe. It just says that something is definitely unsafe. So with that view, we basically we developed our own kind of system, and we started running every protocol through a bunch of checkpoints and ranking the score that the protocol gets. So, if there's a lending protocol, historically, you can attack lending protocols in like 10 different ways. So have they mitigate against all of those things, and then they score, 0 to 50, 20 to 50, 50 out of 50. And on the back of that, we can say something is, AAA, triple B, triple C. And that allows us to run a very, very diversified portfolio of like 30 to 40 platforms at any point in time, sizing things accordingly. Because, something like an Aave is, a million times safer than something that just came out today on a random chain with no audits and like an on team. So clearly you can't put, the same size in those places. And when you do it consistently, and on top of that, you have real-time, risk management tooling to detect risk events, then you're doing the best you can to minimize the impact of those unknowns, and statistically over time, you'll be okay. And that's kind of what happened to us, where, we've basically not lost pretty much anything to these events. We've lost like tiny negligible amounts, which are 20 times lower than the average for the industry.
Yeah, that's really interesting. I think with that risk, what types of players are you seeing in the marketplace? Early adopters, we're kind of past that. Do we see more institutional adoption coming in? I know it's a big term everybody uses.
Yeah, yes and no. It depends on what you mean by an institution, right?
Right.
We have the largest people deploying capital on chain are still DAOs, right? It's some project that raised a crazy amount of money and they're just kind of playing with it. So there are, people like ourselves who are playing in this market for a living, right? There are people who are doing it personally, like DJing around. We haven't seen, traditional financial like institutions coming on chain. A lot of them have obviously been tokenizing things, like BlackRock tokenized their fund, and like a bunch of other people, but they're not really participating in DeFi in the same way how we would be. So we're still a bit removed from the real institutions coming on chain and like farming across like a bunch of L2s.
Right. For sure.
Yeah, probably we'll take them a little bit more time to get there.
A little bit.
Yeah, I guess going off of that, just as just the opportunities in the space, where do you see, like, for example, like DePIN, SocialFi, ReStaking kind of play there from a next wave of growth or opportunity? How are you guys kind of positioning yourselves to take advantage of any integration?
Actually, yeah, this is actually something I really want to get into. Let's maybe break these down in kind of three ways. We have DePIN, we have SocialFi, we have ReStaking. So maybe let's start with DePIN. Could you kind of just tell people like what DePIN means and kind of how you guys are thinking about it?
Yeah, absolutely. So the great thing about DeFi is just like the financial sector, it's kind of horizontally underlying everything else, right? It's like no matter what you do in life, you're going to touch the economy in some shape or form. So DePIN is basically an attempt for a lot of businesses to reinvent models which involve physical infrastructure. So we have Helium, a highly successful DePIN project where they've done a very smart job of incentivizing hotspots. So it's like a parallel Wi-Fi universe, Wi-Fi network that is fully decentralized. Great. There are other people doing something similar with AI compute, and. So it's basically real world businesses which involve some hardware, and they're trying to use crypto incentives to bootstrap and build marketplaces, right, and solve kind of the cold start problem. It's very hard, and it's also quite hard to analyze because, like, let's say you were a DeFi crypto specialist, or you come from finance. Like, what the hell do you know about, like, precise geo equipment or Wi-Fi networks? So we've made some investments in the sector. There are some very, very smart founders, but basically, at its essence, it's building, a real business using some tooling that DeFi can provide. And then restaking is, something that's completely different, where you are kind of invited to rent out your capital to underwrite security of specific networks, and that's a phenomenally exciting concept, because you can just do the vanilla staking, and you're like, okay, well, if I'm putting my capital at risk, and I'm saying that the Ethereum network will perform as expected. Okay, great, fine. You can do the same with the smaller, sub-network AVS or whatever. But also, some people have come up with very, very innovative use cases to basically use that capital as an insurance pool, where you can, it's basically, because restaking at its essence, it says you can delegate your capital from your wallet into like this magical place. And this magical place is effectively an insurance pool, whether it's a chain, a credit default swap, or. And it's very early because we don't have like clearly defined use cases of that quite yet. But it's an amazing concept because restaking doesn't earn much today, but the cost of that capital is also very low. So if you have, ETH, you can stake it or you can restake it. That's pretty much. So the incremental cost to you to restake it is basically zero, which brings down the cost of that insurance capital very, very substantially. So if today someone will come to me and say, hey, I'm launching this insane thing, stake your capital and underwrite my risk, I'm like, okay, sure, like pay me 20% or more. And they're like, well, yeah, it's expensive and our business model doesn't work at 20% cost of capital. But if you're basically tapping into this bottomless pool of restaking capital, which costs much less than 10% realistically, it's incredible, right? So it can unlock very exciting business models, all on the back of this kind of DeFi gamification and kind of staking mechanisms. So,
And kind of walk us through that a little bit. So somebody stakes on Ethereum, kind of, how does it progress from there?
How does it progress in terms of the mechanism, or?
Yeah, like I know, you get the Lido token, Lido.
Yep. So imagine that you have your ETH and you want to earn some yield. So you can put into Lido in your example to stake it, right? To do liquid staking. And you're basically underwriting Ethereum security risk. And then you can take that asset and you can put it into yet another place to earn some additional yield. And when you do that, when you put it into that magical box, that box has different and additional types of risks within it. And restaking basically allows you to choose the risk you want to delegate towards. So there are some people who are launching credit-like instruments, and then if you delegate your restaked ETH to them, you're basically underwriting credit risk. Someone else is creating a DePIN network of like AI compute and like a bunch of other things. And when you delegate to them, you're basically earning additional yield because you're kind of betting on their platform surviving and not blowing up. And then. So it's like a pyramid of additional risks you can take on. Obviously, that comes with risk. And eventually, if there is risk, something will blow up and someone, will lose capital because that's just the way it is.
Yeah.
But there is one thing crypto is very good at. It's very good at selling risk to people and creating incentives for people to chase it. So I have no doubt that some insane business models will come out on the back of that.
Yeah, for sure.
Yeah.
You bring up some good points. Obviously, there's a lot of talk on restaking risk, right, out there. What blind spots do you see in how the market is currently pricing or maybe ignoring the correlated validator risk in the marketplace?
Yeah. So right now, that risk is not being priced at all,
Yeah.
because the only way for someone to say, well, in order for risk to be priced, there has to be different cost of attracting capital to different places. And right now, all you have is points, right? So if I take my Lido staked ETH, which is giving me the usual staking yield, and I put it into some restaking platform, in most cases, I will just get points, which is basically a promise of a future token of that project, and that no one knows how to value these things. Well, I mean, you can try to value these things, but it's a guesstimate.
Yeah.
So therefore, there is no market for that risk today. You can argue that in most cases today, it's as close to risk-free as it gets, because a lot of these AVSs and these platforms which risk you're underwriting, they don't actually live yet. So they've collected these
Mm-hmm.
pre-deposits. In exchange for these pre-deposits, they're kind of promising, future tokens through these points. But they're not live, and therefore nothing can go wrong. Well, almost nothing. So you can argue that it's okay for now, but in our experience, risk is never priced correctly in crypto. So when these things do go live, we expect there's going to be some substantial mispricing. So to give you a specific data point on that, so with our risk index, we track of what, in TradFi, you're like, well, what is a triple A bond yielding today? What is a triple B bond yielding today? So we track this for all the platforms. And very often we'll see that, a double A, for example, will earn you more than something that's much, much higher risk. So people don't yet have this systematic way of thinking, because DeFi is still very chaotic and very, very messy. And the same will flow and will apply to restaking.
The last one is the SocialFi. What are you guys seeing in terms of SocialFi?
We're super excited about SocialFi. We even launched a dedicated venture strategy to be, first ticket in the early stage companies in that sector. And when I think back to Web 2, let's say what's the most popular app today? TikTok, right? You can't have TikTok before you have a WhatsApp. You can't have a WhatsApp without a Facebook. You can't have a Facebook without, Yahoo. And you can't have a Yahoo before you have the cables. So everything is in a very evolutionary. And we were sitting down and we were thinking, what is the evolution of DeFi? We've built the base layer of, a PayPal, a lending and whatever. And we think it can go kind of in two different directions. You can have the institutions to eventually come into DeFi, and then, you're a customer of, I don't know, JP Morgan Chase, and in the back end it's using DeFi and you don't even know. Well, hopefully it will happen, and if it does, then all these vaults they'll grow pretty substantially. But there's another element where these things like Pump.Fun being the coolest example of that. You have these social media like experiences where you have the virality of social media with some financial nonsense of DeFi, and these things can grow on steroids. So with that, we backed Lens. We very active in the Farcaster ecosystem, and we're basically betting that there is a very reasonable probability that the growth of our space is not going to come just from the institutions. It's going to come from normal people using social media like apps with some DeFi and crypto elements behind them. And there is early evidence that that's happening already, but it's truly a venture bet, because you can't, like, a BlackRock using DeFi, you can see it on the horizon. Maybe there are 10 steps, but you can see it. With this social and consumer stuff, you can't really see it. It's very foggy. So it's clearly very asymmetrical because it's a very underbanked, underfunded sector. Because it's very risky and it's very confusing and it's very messy. But we like messy and we like confusing.
Right, it's very new. It's I mean, like the first thing that comes to my mind, like, I know Elon's kind of done this to some degree with like X, where, hey, if we get people to like pay, you can kind of verify they're more, nobody's, or I should say maybe not nobody, but nobody's generally going to be funding 10,000 bots, at $8 a month. So is that kind of how you see the SocialFi kind of building out, where it's kind of like payments, kind of ensuring they're real?
It's limitless in terms of what it can be, right? It can be, you're reading an article about some event, and there is a button, and you can tap into a prediction market, like what's going to happen. It can be a frame in Farcaster where you're reading about something, you can lever up on that thing, right? So it's merging these things together. If you think about Fund.Fun, it's like the quickest way to get dopamine into your system. You download the app, you fund with one coin, and then you see something going up and down like crazy, even before you buy it.
Yeah.
So
Yeah.
it kind of gamifies finance and financializes the social experiences. So I think the really successful apps that will win, I probably can't even imagine what the business model would look like, because by definition, it's not going to make any sense until it does.
Yeah.
Yeah.
It's definitely interesting to see the kind of the adoption. I'm curious. I mean, what do you think needs to happen from a speculation to like utility perspective? Obviously, pumped up fund is an interesting use case, and we've seen kind of that kind of grow over time here. What role do you guys want to play in the space in that SocialFi ecosystem?
In the SocialFi ecosystem, we want to be backing, the best and the brightest founders who are trying to build something of utility, not purely for speculation, right? So I think it's important to acknowledge the speculation in our industry will never go anywhere. That's what brought us here in the first place. So we need to be rational about that, but we also need to be rational about the fact that if that's all we can offer to the world, it's not going to go very far. So it's having some real additional utility whilst acknowledging that we're not quite there yet. So backing the best and the brightest is an obvious one. Then eventually, DeFi and SocialFi, these are all pretty much the same concepts. So we're going to continue to be a key liquidity provider in that world. And eventually, some of these vaults that we're running will also evolve. So a year ago, for example, we built a Farcaster frame, which allowed you, with one click to like route into some of our vaults on the base blockchain. So when I think back to the kind of financial giants of the past, like the Medicis, the JP Morgans and whatever, these were people who were building something, who were providing liquidity, providing financing, they were investing. So it's a very multi-dimensional way of doing things, and that's probably the most fun way of doing things in our industry as well.
Yeah. I guess on to add to that, you've been through many cycles as well. You got to get unique perspective in the marketplace. What's one piece of DeFi infrastructure or tooling you wish existed that maybe it's not built yet?
Where to begin?
Right.
So the main complaint I have about DeFi is that the user experience is obviously horrible.
Yeah.
Right. So it's like the more I use DeFi, the more I appreciate the Web2 banks.
Yeah.
So what we truly need to solve is the wallet and the cross-chain experience, right? So and I think we're not far, right? There's a lot of account abstraction tooling that's been built, and with these AI agents, you can do some very smart things. So you can say, okay, move my USDC from my take it off from Camino on Solana, bridge it to some random chain, put it like there. Maybe it will be text prompt or what have you. But once we solve that, things become truly amazing, because right now everything is very, very isolated, right? Liquidity is fragmented, user experience is very clunky. We do need to solve it because, frankly, if we weren't doing DeFi for a living, we would be very, very tired by now.
Absolutely.
Tell us about the future of Re7 Capital and Re7 Labs. How do you see things progressing over the next couple of years?
That's a good question. The reality is when you're building and you're in the motion, you've got no idea where it's going to take you, because it's just too unpredictable. But we've set a kind of a mission for ourselves to become kind of the key financiers of this DeFi world, which means that we need to be supporting as many teams as we can with liquidity, with tooling, with capital, building our own tooling and making sure that we can lift the risk management standards. Because what people often forget is that we're all in the same boat, where if one person does something horrible in DeFi in one end of the world, is going to echo through the rest of the industry. And for the last few years, we had to be accountable for FTX, because like, what did guy we have to apologize for what that guy did. So I think spreading the word and educating, especially the traditional investment institutions and the investment world, is very, very important. So we continue to spread the word and just building important stuff, and then keep scaling until you're too tired to do that.
Yeah, I love it. Evgeny, this has been a lot of fun. Really appreciate you joining us, sharing your insights. Where can people go to connect with you and learn more about Re7?
Yeah, go to Re7.capital. Go to Re7 Labs, Re7 Capital, Twitter, LinkedIn. We're all over. And we're hiring very actively. So please check out our career section and apply.
Awesome. Well, this has been amazing. We'll make sure to include all your contact info in the show notes as well, Evgeny. This has been a good conversation. Appreciate your time.